March 16, 2013. A Saturday morning, Maria Georgiou wakes in her apartment in Nicosia to messages from friends asking if she's seen the news. She hasn't. She makes coffee, checks her phone, sees the headlines. The government has announced a stability levy on all bank deposits. Her account, 80,000 accumulated over 30 years, teaching will be taxed between 6.75% and 9.9% depending on the balance. The banks are closed. The ATMs have withdrawal limits. Online banking shows a balance, but transfers are disabled. She calls the bank. The line is busy. She drives to the branch. The doors are locked. A printed notice taped to the glass. She stands there with a dozen other people, none of them speaking, all of them staring at the same piece of paper. By Monday, she learns that the levy might not happen exactly as announced, but the damage is done. The money she believed was hers has revealed itself as something else. Not savings, not property, a claim, a permission, an entry in a ledger that someone else controls. She asks a question that thousands ask in moments like this. How does money in a bank just stop being yours? That question has been asked before. Greece 2015. Withdrawal limits of 60 years per day. ATMs running dry within hours. Pensioners lining up at banks before dawn. Argentina 2001. The Corralito. Accounts frozen. Deposits forcibly converted to devalued pesos. Riots in Buenos Aires. Iceland 2008. Krona controls, foreign currency restrictions, capital trapped inside national borders. Lebanon 2019 onward. No formal capital controls, just banks that stop honoring withdrawals, a slow paralysis that becomes indefinite. China's ongoing system of currency controls so normalized that most citizens don't think of them as restrictions, just the way things are. These aren't isolated crises, they're not anomalies, they're recurring. Different continents, different political systems, different stated causes, but the same administrative reflex, the same weekend timing, the same temporary language that becomes permanent. The same categories of people who get caught and the same categories who don't. What looks like emergency response is actually standardized protocol, a playbook implemented again and again with only minor variations. And yet, each time it arrives as a surprise. That gap between pattern and perception is worth understanding, because the pattern is structural, and structure doesn't stop repeating just because it's ignored. To understand why capital controls keep happening, you have to understand what money actually is in a modern financial system, not what it feels like, not what we're taught, what it is structurally. There are 3 layers. The first layer is physical currency, notes and coins, legal tender. If you hold a $100 bill, you possess an asset. It's not a claim on an asset, it's the asset itself. The second layer is a commercial bank deposit. When you deposit that $100 bill, you no longer own currency. You own a claim against the bank. Your account balance is the bank's liability. You've become an unsecured creditor. Most people don't think of themselves that way, but legally, that's the relationship. The third layer is the digital ledger. Your account balance is an entry in a database, and access to that entry is governed by administrative permission. The bank controls the ledger. The central bank regulates the bank. The government regulates the central bank. You're at the bottom of a hierarchy, and everything you think of as your money is actually a series of permissions granted by institutions above you in that structure. This isn't a conspiracy, it's just architecture. But architecture has implications. If most of what we call money is actually a permission to access a ledger entry, then the question isn't whether that permission can be revoked. The question is under what conditions revocation becomes policy. The toolkit for implementing capital controls is well established. Withdrawal limits are the most visible. Greece is €60 per day. Cyprus initially proposed limits before settling on the deposit levy. These limits can be daily, weekly, or per transaction. Transfer restrictions come next. Domestic transfers might remain open while international wires are frozen, or vice versa. Currency exchange controls prevent conversion from local currency to foreign currency, or impose punitive rates for those who try. Asset freezes target specific account holders, often justified by anti-money laundering language or national security. Bank holidays extend weekends into weeks, giving institutions time to prepare implementation while account holders remain locked out. Forced conversions redenominate deposits from one currency to another, usually at rates unfavorable to the depositor. Argentina's conversion of dollar deposits to pesos is the textbook case. And then there are tiered access systems, where different rules apply depending on account size, citizenship, or institutional relationship. The ultra-wealthy often retain access through private banking channels. Foreign corporations negotiate exemptions. But the middle class, with standard accounts and domestic concentration, gets the standard restrictions. The language is always temporary, always protective, stability measures, safeguards, emergency provisions. But the digital infrastructure of modern banking makes implementation instant and comprehensive in ways that weren't possible in previous eras. There's no need for physical barriers at bank branches. The restrictions are coded into the system. A switch flips and access changes. Not because your account balance changed, but because your permission changed. So who gets caught? Not everyone faces the same exposure. Think of it as geometry, 3 tiers. At the top, the ultra-wealthy. By the time controls arrive, they've already diversified. Multiple jurisdictions, offshore structures, foreign real estate, precious metals. Their wealth isn't concentrated in domestic bank accounts because they've had access to legal and financial advice that treats diversification as baseline prudence. When controls hit Cyprus, Russian oligarchs had already moved significant deposits out. When Greece imposed limits, shipping magnates had long held accounts in London and Zurich. At the bottom, the working poor. They're affected by controls. Limited cash access disrupts daily life, but they don't hold enough wealth in the system for controls to be financially catastrophic. The impact is immediate, but not wealth-destroying. In the middle, the professional class. Engineers, teachers, mid-level managers, small business owners, doctors. Their wealth is concentrated. Domestic bank accounts, retirement funds. A home, maybe a second property. They followed the rules, kept savings in regulated banks, contributed to approved pension systems, paid taxes. That compliance, that concentration becomes structural vulnerability. They can't diversify the way the wealthy do. Regulatory and tax structures make cross-border planning expensive and complex for anyone not already operating at scale. And they don't have the liquidity flexibility of the working poor because their wealth is tied up in illiquid domestic assets. So when controls arrive, this tier experiences maximum exposure. Their wealth is visible, accessible to administrative seizure, and often denominated in the same currency and jurisdiction as the crisis itself. Not because they were reckless, because they were compliant. What triggers the shift from theoretical possibility to actual implementation? 5 conditions appear repeatedly. First, banking sector insolvency. When a bank's assets are worth less than its liabilities, deposits stop being backed by real value. They're just numbers in a ledger, claims on an institution that can't honor them. Second, currency depreciation pressure. When a currency weakens rapidly, capital tries to exit. People convert savings to foreign currency or move money abroad. That flight accelerates the depreciation, creating a feedback loop. Third, sovereign debt crisis. Governments that can't borrow affordably face a choice: default or seize domestic wealth. Capital controls are a way to trap wealth inside the system long enough to tax it, convert it, or restructure it. Fourth, capital flight acceleration. Once the wealthy start moving money out, everyone else notices. The flight becomes a stampede. Controls are implemented to stop the stampede, but often too late to prevent the wealthy from exiting. Fifth, political legitimacy crisis. When populations lose trust in institutions, bank runs become self-fulfilling. Even solvent banks face liquidity crises when depositors demand withdrawals en masse. These 5 conditions don't always appear in the same order, and not all 5 need to be present. But look at any historical case of capital controls, and you'll find at least 3 of these conditions converging. Cyprus had banking insolvency, currency pressure within the Eurozone periphery, and sovereign debt trouble. Argentina had currency collapse, capital flight, and political crisis. Lebanon had all 5. The conditions cluster because they're not independent variables, they're symptoms of the same underlying math. Here's the math. Fractional reserve banking means that banks hold only a fraction of deposits as reserves. In most systems, that fraction is around 10%. The other 90% is lent out or invested in longer-term, less liquid assets, mortgages, government bonds, corporate debt. On a normal day, this works. Most depositors don't withdraw their money. The bank can meet withdrawal demands from reserves and short-term liquidity, but if 15% of depositors want their money at the same time, the bank doesn't have it, not in cash. The assets exist, but they're illiquid. The bank would have to sell a 30-year mortgage at a loss to raise cash immediately, and if many banks try to do that simultaneously, asset prices collapse, making the shortfall worse. This isn't a problem during calm. It's a catastrophic problem during stress, and it gets worse when you add sovereign debt, Banks hold large quantities of government bonds. Regulators classify these bonds as low risk, even risk-free, which incentivizes banks to hold more. But if the government's creditworthiness deteriorates, those bonds lose value. The bank's assets shrink. Its solvency comes into question. Depositors get nervous. They start withdrawing. The bank faces a run. The government, already in fiscal trouble, now faces a banking crisis. It can bail out the banks, but that requires borrowing more money, which worsens the sovereign debt problem. Or it can let the banks fail, which destroys the financial system and triggers economic collapse. Or it can implement capital controls. Freeze the deposits. Stop the run. Buy time. The controls don't fix insolvency. They don't make the bank's assets worth more. They just stop the clock. They prevent the math from resolving in real time. And that math is simple if you have a system where total claims exceed available liquidity, and you can't print your way out because you're in a currency union or because printing would collapse the currency, then the only way to prevent mass default is to prevent mass withdrawal. Capital controls are the mechanism, not a failure of policy, a feature of the architecture. Zoom out further and you see the doom loop. Banks hold sovereign debt. Governments rely on banks to fund deficits. When sovereign creditworthiness falls, banks holding that debt see their balance sheets deteriorate. When banks weaken, governments face bailout costs, which worsen fiscal positions, which further damages creditworthiness. It's a feedback loop with no natural exit. The European sovereign debt crisis from 2010 to 2015 made this visible. Greek government bonds lost value. European banks holding those bonds faced losses. Governments had to support the banks. The support increased government debt. Ratings agencies downgraded sovereign credit. Bond yields spiked. The cycle continued. Capital controls in Cyprus and Greece were circuit breakers, not solutions. They stopped the loop temporarily by freezing one variable deposit flight, but the underlying insolvency remained. The architecture ensures that banking crises and sovereign crises aren't separate events. They're two sides of the same balance sheet. When one side fails, the other follows, and capital controls become the last tool available before systemic collapse. Understanding this changes the frame. The question stops being, how do I avoid the next crisis? The question becomes, where am I positioned when the math resolves? Structural resilience starts with jurisdictional awareness. If all your wealth is in one country's banking system, denominated in one currency, you are entirely exposed to that jurisdiction's administrative decisions. Diversification across borders isn't about paranoia. It's about reducing single points of failure. Then there's the liquidity spectrum. Cash is maximally liquid but loses value to inflation and can be restricted by withdrawal limits. Precious metals are portable and hold value but aren't easily spent. Foreign bank deposits offer access outside domestic controls but carry their own counterparty risk. Real estate is stable but illiquid and subject to property taxes and seizure. Each asset class has trade-offs. Understanding where you sit on the liquidity spectrum clarifies what you can and can't do when access tightens. Counterparty risk is central. Every bank deposit is an unsecured loan to an institution. That institution's solvency determines whether your claim has value. Most people don't assess their bank's balance sheet. They assume deposit insurance covers the risk, but insurance funds are fractional too. They work when a few banks fail, not when systemic stress hits many banks simultaneously. Then there's functional skill. Paper wealth can be frozen, taxed, or converted. Skills that produce value, technical abilities, professional expertise, trade skills operate outside digital ledgers. They can't be administratively seized. And finally, network capital. Relationships across sectors and jurisdictions provide resilience that wealth alone doesn't. These aren't prescriptions, they're variables. Understanding them allows clear assessment of where structural exposure sits and what the geometry of your position looks like when systems tighten. Resilience isn't about predicting the exact moment capital controls arrive. It's about understanding the architecture well enough that when the moment comes, you're not defined by it. Maria in Cyprus didn't lose everything. The levy was eventually restructured, applied mainly to uninsured deposits over €100,000, and she recovered most of her savings. But the weeks of uncertainty, the loss of control, the realization that her money was never unconditionally hers that changed her relationship to the system. She started holding more cash. She opened an account in Germany. She stopped thinking of her bank as a safe deposit box and started thinking of it as a counterparty, not because she panicked, but because she understood. And understanding is a form of positioning. It doesn't require dramatic action. It doesn't require abandoning the system. It just requires seeing the system clearly, seeing that capital controls aren't aberrations imposed by rogue governments. They're structural features of debt-saturated, digitally administered financial systems operating near the edge of their mathematical limits. When claims exceed assets and liquidity dries up, controls are the release valve. They arrive without warning to those who aren't watching, but the conditions that produce them are visible long before implementation. Banking fragility, sovereign debt loads, currency stress, capital flight. These are the variables. When enough of them converge, the playbook gets implemented. Again, the pattern holds because the architecture holds. What looks like surprise is just the gap between perception and structure. The structure has been visible the entire time. In the fractional reserve system that treats 10% reserves as sufficient. In the sovereign banking doom loop that ties government solvency to bank balance sheets. In the digital infrastructure that allows instant administrative control over access. In the tiered system where wealth concentration determines exposure, the Cyprus schoolteacher asked how money in a bank just stopped being yours. The answer is that it was never unconditionally yours. It was a claim, a permission. Conditional on system stability. Capital controls don't change the rules, they reveal them. And once the rules are visible, the question becomes not how to predict the next event, but how to position outside the concentration zones where exposure is maximum and options are minimum. The systems we build carry their own mathematics. Understanding that math doesn't prevent the equation from resolving, but it changes whether you're inside the calculation when it does.